Hey everyone, today I want to get into a concept I call the options triangle, which has proven to be a useful model for me about how I think of doing my options trades. Just a disclaimer, I'm not an economist, I'm not an investment advisor. Everything I talk about here are just my ideas and concepts, and you can use them at your own discretion. As derivatives, options gain both the boon and the bane of having more factors impact how their price changes. Unlike stocks, which are pretty much buy long or sell short, with options, a trader can buy or sell, choose a long or short side, combine long and short positions, and determine entry and exit opportunities based on volatility, time, and direction, among other factors. There's also the interaction of the underlying and its options, such as with covered calls, and the ability to mimic long or short stock positions via synthetic option structures. Now, for my style of trading, I keep in mind a lot of these factors, but rarely touch them except for with rare opportunities or certain types of repairs that I might do. When I trade, my main focus is on three elements: time, volatility, and direction. And these will be the focus of my discussion today. My trading style involves selling neutral spreads, most typically strangles at a high IV rank, and then allowing time and volatility decay to bring the price down to my desired exit. That's simple enough, right? But of course not. And that's where the triangle comes into play. But first, I want to start with an analog from photography. Now, I practice photography as a hobby, and one of the most profound things I learned was this thing called the exposure triangle. So without getting into too much detail, the exposure triangle is a balance between the ISO, the shutter speed, and the aperture. If you adjust one, keeping the others the same, you increase or decrease the exposure. Which element, and to what degree, determine things like the depth of field, sharpness, and graininess of the photo, all of which need to be taken into account depending on your artistic tastes and the lighting in the shot. The nice thing about the exposure triangle is that a photographer has control of everything on the camera side. Adjustments are made to account for external elements. I've taken this concept of the exposure triangle and applied the model to my personal trading viewpoints. Whether I'm entering or planning to exit a trade, I'm taking into consideration the three factors of time, volatility, and direction, and these form the options triangle. Unlike in photography, however, a trader doesn't get the luxury of simply setting the values of taking a shot. In options, the triangle itself is dynamic. Each of the vertices is ever shifting as the market ebbs and flows through the days, weeks, and months. Keeping in mind the 3 points of the options triangle can help a trader make better choices on entry and make profit-saving decisions regarding exits. First, let's talk about the specific points of the triangle, and then we'll get into how they work for entry and exit. The vertices of the triangle are, as I've said, time, volatility, and direction. Now, more specifically, on a technical level, they are theta, implied volatility, and delta. Now, for the purpose of this discussion, I'm not going to go into a lot of details on these. My intention is to provide a framework of thinking more so than going into technical details. So I'm just going to gloss over each of these in their technical terms. Theta is the decay of an options price over time. All options have an expiration date, and thus all options lose time value for the duration between their open and the expiry date. Volatility, specifically in my mind, I make use of the implied volatility rank. Implied volatility in general is the anticipated volatility that adds value to the price of an option. The higher the relative implied volatility, the higher the overall price added to the option. As the IV decays over time, the price of the option likewise drops. A side note, how sensitive an option is to the change in IV is called the vega. Lastly, we have the delta, which is the amount an option's position changes for each dollar move in the underlying. Now, delta actually has other definitions and can be used in a variety of ways, but the main thrust of delta is that it indicates how much an option price will change as the underlying changes. And this becomes important to note relative especially to implied volatility. Now, entering a position is fairly easy, but arguably it's one of the most important parts of a trade. It's far easier to enter into a bad trade than a good trade. A good trade entry always requires patience. I use the triangle to help me remember what I need to make a good entry. In terms of volatility, this is a big one for me in my trading patterns. I always want to get into a position with high volatility, so as it drops, the price also drops. Because remember, I sell to open and thus I buy to close, so I need the price to be lower than when I entered. With regards to time, I need that time for the volatility to drop. Typically, I give myself 30 to 60 days from expiration to pass. An ideal position is one where volatility simply drops before the day is over, but those are simply very rare birds to find. Generally speaking, a stock has risen in volatility for a reason, even if I don't know what that specifically might be, so it's going to need time to drop. Lastly, it reminds me of direction. Since I picked neutral positions, the ideal state is for the stock not to move at all for the duration of the desired IV drop. But direction can only be taken into account after the trade is made. So what role does it play on entering a position? Well, in the case of a sell-side neutral position, it requires the selection of stocks that balance any sort of anticipated move up or down. So for entry, I use the delta's definition of the probability of touching a particular strike. The spread has to be wide enough that any movement that does happen with the underlying stays range-bound between the two chosen strikes, at least in the case of a short strangle. Other factors such as news and recent price action might influence my choice to enter a particular position, but these three elements, volatility, time, and direction, are the main ones that ultimately guide me. It is in the middle of a position that the triangle becomes particularly useful. Once the position is open and the limit order to exit has been placed, ideally a trader just needs to wait for the underlying to do its thing. With my typical strangles, I just want to wait for the IV to drop to a sufficient level to exit at my desired price before the position expires, hopefully 21 days or more before expiration. If all goes well, the triangle did all the work on open and I don't care what happens after that. But this is the stock market we're talking about. Things happen, and this is where the triangle becomes extremely useful for my style of trading. To be clear, when things happen, they are usually bad things, and thus I'm using the triangle to consider adjustments to my limit order for an exit. I'm willing to take a smaller profit if that means overcoming the additional risk that occurred from the bad event happening. I like to think of the triangle on its side, with time on the right-hand side and IV in direction on the two left vertices. I think of it this way because time, in the form of theta decay, is always present, and it's either growing or shrinking, relatively speaking. Either I have enough time to exit the trade, or I don't have enough time to exit the trade. No trader can stay in a position indefinitely. All options must expire. In the case of neutral sell-side positions, direction is always an opposing force. The more extreme the move, the less theta decay is useful to me. Directional shifts can easily overcome any hope of closing before expiration. A trader must either roll or exit at a lower profit or loss. And rolling may prove inadequate in some situations simply because it takes far more rolls than a trader has patience for, and rolls also depend somewhat on the IV conditions. Implied volatility is bilateral in nature. It can either have a positive or negative effect depending on what level the IV was when the trade was originally made. An increase in IV will, like an extreme delta move, lower the effectiveness of the time value. A decrease, of course, is usually helpful. And I say usually because if a position has not yet exited and the IV is extremely low, usually below 20% IV rank, then IV is not really that helpful. In fact, it can become a liability as it is more likely to go back up, thus increasing the price and the duration required to stay in the position. Chances are, if a trader is in a low IV position, assuming that the entry was done properly, the underlying has made a directional move for the worse. And I usually see this happen with extreme up moves. The position goes up, the IV goes down, and the position is hard to exit. In such cases, it's better to exit for less than originally anticipated or take a scratch if possible. As options traders, we're always juggling a number of elements. I find that thinking in terms of this option triangle has helped me a lot over my trading career. It helps remind me of best practices on entry, and it helps me take into consideration the push and pull effects of IV and directional biases on the amount of time that it's going to take me to exit the position. By keeping these in mind, I can make rational choices on how I might alter my exit when the positions go awry. I hope you found this useful. Let me know what you think in the comments. Best of luck in your trading, and thanks.